Good morning, everybody. As you know, markets move pretty fast this week with significant technical events, so that I will discuss on oil prices, on government bonds, on gold, and we will end this presentation with an overview of what's happening on the S&P 500. So if we start with the main topic of the week, it's the big decline we saw on US government bond yields. So as you know, bond yields accelerated sharply upwards over the last, let's say, few weeks, and are now reaching an important support zone, which is the next one, around 2%. So why 2%? You can see obviously on this chart that 2% is a 61.8% retracement of the entire rise between 2016 and the end of last year. So it's supposed to be quite important Fibonacci ratio, and you can also see that we have the lows of mid 2017. So overall, given a strong decline of bond yields, I would expect yields to stabilize over the last possibly few weeks, maybe even few months above this 2% area. I also noticed that this is the strongest downside acceleration in terms of momentum since the summer 2011. So as a reminder, this was the Greek crisis, and the Eurozone was close to collapse. So what the US bond market is pricing right now is a big economic slowdown. So that's something quite puzzling, because it shows that bond markets are becoming extremely negative in terms of economic growth, so probably world economic growth. So the bond markets, I showed you the US, but it's the same event in Europe with German 10-year bond yields hitting new historical lows. So what we are seeing right now is a very bearish sentiment towards economic growth on government bond markets worldwide. If we look now at Brent prices, as you know, Brent prices accelerated sharply downwards this week. I was expecting such a correction, but I must admit that the speed of the decline is really puzzling. Oil prices have now reached the same Fibonacci support at 61.8% retracement this time of this year advance. So the 60 area is a very important support. We could start to see a technical bounce. That's already what we saw yesterday. We could start to see a technical bounce from this important support, but I wouldn't bet on a sustained recovery from here. The risk is to start a technical bounce, then go back below 60 to the next Fibonacci support at 56. So although prices are back to attractive technical levels, I wouldn't bet on a strong recovery. As a reminder, Brent prices are usually very difficult to anticipate, especially it's very difficult to catch extreme levels. We saw this decline, this huge decline last year. So it's I would be very careful about calling a bottom on oil prices, because oil prices can go much higher than we expect during uptrends and much lower than we expect during downtrends. So all we can expect here is a short-term turning point, but don't overstate this technical bounce. Another quite important topic this week is also the sudden recovery of gold. So gold was trading sideways since a couple of months. The chart was not very attractive, and the gold was at a crossroad between two scenarios. The bearish scenario, typically a remake of what we saw last year, which is a breakdown below the 200-day moving average, and the other one is a more bullish scenario, which was holding above the 200-day moving average and back to this major resistance line here, and with possible breakout ahead. So we can see that this is the bullish scenario which gained the favor of the market over the last weeks, over the last week, with prices holding above their rising 200-day moving average and even breaking out this week. And so what we see right now is that prices should again retest the major resistance line, and I think there is a higher probability now of seeing a sustained upside breakout above this major resistance line, which has been forming since 2013. So keep an eye on this chart with potential significant technical breakout ahead. The last chart I wanted to show you is the one of the S&P. So if we start with an update on what I told you over the previous weeks, I always warned that since the start of the correction in early May, that the risk on the S&P was to retrace around 32% of this year uptrend. Notice that this level was almost hit at the start of the week, and we saw a very bullish technical reaction from the support zone. So it was the Fibonacci support as well as the minor low we saw here. So pretty bullish reaction here, which is quite positive for the US stock market. Also a strong recovery from the 200-day moving average. So we can see that over the last years, the 200-day moving average has been usually a very important support, or at least prices have spent time oscillating around this 200-day moving average. So are we going to see only a technical bounce after a big drop like at the end of last year, or is it going to be something more bullish, such as a strong recovery back to new highs in coming weeks or months? I would say that right now I'm favoring the intermediate scenario, which is potential formation of a trading range between these two boundaries. Possible formation of a triangle formation. So if we have a triangle, it could be something like this, with sideways trading for a significant amount of time within a triangle or a flat or something like that. So that's obviously what I'm favoring. If you want to find a similar case in the past, I would say that what happened in the first half of last year is quite similar. So maybe we have done the initial decline here, or are due to rise again, then after that fall again, and so on. And this could last a couple of months. Last point, so as an introduction, I told you that the S&P was still at a high level according to historical standards. Okay, this is true on prices, but this is also true in terms of valuation ratios. I show you here one valuation ratio I like a lot, which is the price to sales. So this is a price to sale ratio since the late 1990s. So as you can see here, the S&P moved above 2% in terms of price to sales ratio only twice in the past 2 decades. The first event was at the end of the TNT bubble in 1999. 2000, and over the last 2 years. So we can see that from this valuation ratio, the S&P remains at quite high levels according to historical standards. So we can see that there is a mismatch between what the bond market is pricing right now, which is potentially a big recession ahead of us, and what the equity market is pricing, which is persistent strong growth. And we can see that this is my main problem right now, because both markets are giving you a different message. So it will be quite interesting to see what will happen in coming weeks. I think there is an excess right now, to be honest, on the bond market. Thank you very much for listening, and have a great weekend.